Welcome to StokTok's deep dive into TJX Companies Inc. TJX is the largest off-price apparel and home fashions retailer in the United States, operating banners including TJ Maxx, Marshalls, and Home Goods. At the time of recording, shares trade at 160.68, sitting just below the 52-week high of 165.82, and meaningfully above the 52-week low of 119.84. The 50-day moving average stands at 157.85, above the 200-day moving average of 145.8, a technically constructive posture. The RSI 14, a momentum indicator on a scale of 0 to 100, reads 53.1, firmly in neutral territory, suggesting no near-term overbought or oversold extreme. Let's work through the fundamentals, scene by scene. Starting with a quick business overview. TJX Companies operates a treasure hunt retail model, sourcing excess inventory from brand manufacturers and department stores at steep discounts, and passing a portion of those savings to shoppers. The moat is operational: decades of vendor relationships, a lean supply chain, and a store experience that rewards frequent visits. The StokTok score comes in at 57 out of 100. A hold signal. Valuation scores 10 out of 20, health 16, profitability 12, growth 11, and smart money 8. A business of genuine quality carrying a price tag that demands scrutiny. Now, valuation. The question every investor has to answer: are you paying the right price? At the time of recording, TJX Companies carries a trailing price-to-earnings ratio of 32.93 times, meaning investors are paying roughly $33 for every dollar of trailing earnings. For context, the broader consumer discretionary sector has historically traded in the mid to high 20s on this measure, so TJX commands a visible premium. The PEG ratio, which adjusts the price-to-earnings multiple for expected earnings growth, stands at 0.84. A reading below 1 is generally interpreted as growth not fully priced in, and that is a constructive signal. The EV to EBITDA ratio, enterprise value relative to operating cash earnings, is 21.47 times, elevated by most historical standards for retail. The GuruFocus Value at the time of recording is 128.74, implying a premium to intrinsic value of negative 24.81%. In our view, that is a meaningful overage that investors should weigh carefully. Wall Street analysts at the time of recording have a consensus mean target of 172, drawn from 18 analysts, with the high target at 193 and the low at 100. The next earnings report is due May 20, 2026, with the street expecting earnings per share of approximately 1.01, ranging from 0.99 to 1.06, a near-term catalyst worth monitoring. Market sentiment around TJX Companies, as of the creation of this video, leans cautiously bullish, supported by growing investor interest in the off-price space and a second-hand retail market estimated at $393 billion. In our view, the valuation is stretched relative to intrinsic value models, even as the business quality justifies a structural premium over weaker retailers. Moving to financial strength, how solid is the foundation? The Piotroski F-score is 8 out of 9. This is a 9-point checklist that tests profitability, leverage, and operating efficiency signals. A score of 8 indicates a financially robust business passing nearly every test. The Altman Z score, a model designed to estimate bankruptcy probability, registers 6.97. Any reading above 3 is considered the safe zone. At nearly 7, TJX Companies is nowhere near financial distress. On the debt side, the cash-to-debt ratio is 0.46, meaning the company holds roughly 46 cents in cash for every dollar of debt. That is not an uncomfortable position for a business of this scale and cash generation. Interest coverage stands at 97 times. That means operating earnings cover interest expense nearly 100 times over, one of the strongest readings you will encounter in large-cap retail. The current ratio, which measures short-term assets against short-term liabilities, is 1.14, modestly above the 1-to-1 threshold that signals liquidity adequacy. Debt to equity is 1.32, reflecting a leveraged but manageable capital structure given the interest coverage cushion. Overall, in our view, the balance sheet is a genuine strength of this investment thesis. Next up, profitability. Is this business actually making money efficiently? We lead with return on invested capital of 23.5%. Return on invested capital, which measures how effectively a company deploys its invested capital to generate returns, is the single most important profitability metric for long-duration investors. At 23.5%, TJX Companies is generating substantial economic value above its cost of capital, a hallmark of durable franchise businesses. Gross margin sits at 30.96%. For a retailer operating on an off-price model with intentionally lean markups, clearing nearly 31 cents of gross profit on every dollar of revenue is a solid result. Operating margin is 11.89%, meaning after store-level costs, distribution, and overhead, almost 12 cents of every revenue dollar reaches the operating line. Net margin narrows to 9.1%, and free cash flow margin, the percentage of revenue that converts into actual cash after capital expenditures, is 8.14%. Return on equity of 60.63% and return on assets of 16.41% are both exceptional for the sector, reflecting TJX's ability to generate outsized returns without relying purely on financial leverage. In our view, the profitability profile here is a first-tier result for large-cap retail. Onto growth. Is this business expanding, and at what rate? Revenue growth over the trailing 3 years has averaged 6.5% annually. Extend the window to 5 years, and the compounded growth rate rises to 12.9% annually, a materially stronger figure that likely reflects the post-pandemic recovery in consumer spending and TJX's store expansion program. The difference between the 3-year and 5-year numbers is worth pausing on. It suggests that the most recent growth phase has been more moderate, and investors should not assume the 5-year rate is the new baseline. Book value per share has grown at 18.7% over the trailing 3 years. Book value measures the net accounting worth of the business per share, and growth at this pace indicates retained earnings are compounding effectively. On dividends, TJX Companies offers a yield of 1.06% at the time of recording. That is not an income story. This is a total return narrative where capital appreciation is the primary driver. The dividend nonetheless signals financial discipline, as management is returning capital consistently. The setup we would want to see going forward is a re-acceleration in the top-line growth rate. The data suggests the business is still healthy, but the growth trajectory warrants monitoring for any further moderation. Now let's talk smart money. What institutional capital is actually doing with this name? 16 top-tier guru investors hold TJX companies in their portfolios at the time of recording. Among the notable holders tracked by institutional filings, Jensen Investment Management carries a position, though it represents a small fraction of their portfolio at 0.06%. And they have recently trimmed the position by 0.17%. A reduced signal, not an exit, but a directional note worth registering. Moving to the broader institutional picture, 15.3% of 13F filers. The quarterly filings large institutions must submit to regulators disclosing their equity holdings are net buyers of TJX at the time of recording. That reading of 15.3% is below the 50% threshold that would indicate broad institutional accumulation. When fewer than 1 in 5 reporting institutions are adding to the name, the smart money signal is, at best, mixed. Insider ownership stands at 0.47%. Management collectively owns less than half of 1% of the company. That is a low figure and suggests limited direct financial alignment between executives and long-term shareholders. In the most recent 3-month window, there have been 0 insider purchases and 1 insider sale. A single sale is not alarming on its own, but combined with the low ownership base, The insider signal adds modest caution to the overall smart money reading. In our view, smart money flows here are neither a strong endorsement nor a warning. They are broadly neutral with a slight note of caution. And finally, the verdict. Let's bring it all together. On valuation, in our view, the price at the time of recording carries a meaningful premium to intrinsic value models, and the trailing earnings multiple is above where the sector typically trades. The setup is not cheap, even for a business of this quality. On financial strength, TJX Companies is on exceptional footing. A near-perfect Piotroski score, a very comfortable Altman Z score, and interest coverage that most borrowers could only dream of. On profitability, the return on invested capital and margin structure are genuinely first-tier for large-cap retail, and the data suggests a durable earnings engine. On growth, the trailing 3-year revenue trend at 6.5% is solid, but has moderated relative to the 5-year picture. We would want to see that trajectory hold or improve. On smart money, institutional flows are below the threshold of broad accumulation. Insider ownership is thin, and there are no recent insider purchases, suggesting the largest beneficiaries are not adding aggressively at current prices. Taken together, the overall thesis in our view is this. TJX Companies is a high-quality franchise with an enviable business model, but the stock at the time of recording appears priced for much of that quality already. The StokTok score of 57 out of 100 reflects a hold, not an exit, but a signal that patience and a better entry point may be warranted. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on TJX Companies Inc. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.